So tonight we're going to talk about taxes in retirement. You know, we just had the tax cut come in and a lot of confusion out there, so we're going to go through some of the things, and then Bree is going to come up and give you a demo of some of the software that we have that will help you as our clients maybe make some smart decisions based off of the new tax laws. Here's how you can contact us, a little bit of information about us. You know, everybody knows about our website. We were founded in '91, retirement planning experts. And I'm sure you saw the emails and you saw all the information, but we are now purely fee-based. I'm not here. We're fee-based fiduciaries, meaning that everything we do is based off of a fee or a fee account, like your Matson account. So we don't do. The only thing that we might do commission-based would be an insurance, but everything else is fee. You've heard my story before. This is the reason I'm here, because of what happened with my parents, and I'll just run through it real quick again for those of you that may have forgotten. My parents were taken advantage of way back in about 1990 by a financial advisor, put them into investments that were ill-suited for them, and it was so financially devastating that by the end of my dad's life, he was living in a FEMA trailer. And so that's what prompted me back in '91 to get into the financial services industry, because I didn't want it to happen to them again, and I certainly didn't want it to happen to me. So that's what prompted me to get into the business. Here's our disclaimer. We're not CPAs. We're not tax attorneys. We can give you what our opinion is based off of financial planning principles, but that's about it. Everything we talk about tonight is for informational purposes only. If you have specific questions, then it's a good idea for us to have a one-on-one conversation. And if you want to talk in conjunction with your CPA, we're more than willing to do a joint meeting and talk with your CPA. All right, so our goals tonight is to help you understand the relevant changes to your personal income tax under the Tax Cut and Job Act of 2017. I want to help you understand the impact on your retirement income streams. And that's probably what's most important for you all tonight. We're going to help you identify tools and strategies that are available to the middle income retirees. And then I'm going to try and avoid politics, and I'm going to stick to what is actionable. So whether you like the current administration or don't, we're not going to talk about that. We're just going to talk about how the tax code now affects you all. You feel like this when you're looking at your taxes, kind of, huh? What? Yeah, you especially the new tax code, you're kind of confused and going, I just don't know or understand. Well, hopefully tonight we're going to get you a little bit clearer on some of the deductions and exemptions and everything that have come about with the new tax laws. All right, here's how it breaks down. Just about everybody in this room, except for one, is married filing jointly, and we'll talk about the single here in a little bit. But the old bracket from $19,051 up to $77,400 was 15%. Now it's down to 12%, and you can kind of know where you stand by looking at the new brackets. So this is how it breaks down. So it is a tax cut, unless you're up here, and then not so much. Okay, so what does it mean? Your first $19,050 of income, you are taxed at 10% of your taxable income. So that would be $1,905. Once you go over that, then everything above that is taxed at 12%. Okay, and that's the way it works all the way up on the entire tax brackets. going to use this tax map to kind of help show you how things work and to break it down and to make it very, very visually appealing. So you can see that the 10% bracket on the chart here doesn't start till about 26, 27,000. And you're going, but wait a minute, you know, up here you're saying it's from 0 to 1950. That's because of the new exemptions, and we'll talk about that here in a little bit. So there's the big jump from 0 to 10%. Then there's another big jump, basically from 24 to 32%. Those are the big leaps in the tax brackets. And so what we try to do with our tax planning strategies is to help you avoid some of these big jumps, if we can. All right, marginal tax rates, that's the tax bracket your last dollar fell into, which, let me go back. This is the marginal tax rate. You can see that you're going to pay the $19.05. You get $1 over, and you've jumped into a higher bracket. That's what they mean by the marginal tax bracket. Does that make sense? Is everybody kind of clear on? Okay.
Mm-hmm.
All right, let's talk about capital gains and qualified dividends. They get different treatment. This is a change. This is something that's kind of changed from before. Public policy goal of different capital gains and dividend brackets is to encourage investment. They want people to be investing in businesses. They want people to be buying bonds. They want people to be doing these things. Similar marginal tax concept to our ordinary income, but the amount above the threshold is taxed at a higher rate. And then prior to the acts, the brackets were linked to ordinary income brackets. Now they just stand alone, and I'll show you what I mean. All right, so if your taxable income is $77,200 or less, hey, no capital gains. Yippee! No capital gains at all. Not bad. Once you get above that, then it goes to the 15%, and once you're above $479,001, you're going to pay 20% on your capital gains. Pretty nice, huh? All right, so here's the staircase again. You can see where it breaks down and jumps up 15% up to 20%. All right. If this was all it was to the tax code, it'd be simple. Things would be great. It isn't that simple. There's things like deductions and exemptions and credits, and we're going to talk about each of those and kind of give you an idea of what the difference is between deductions, exemptions, and credits. All right, so let's jump right in. This is the good part. The standard deduction has jumped up to $24,000 for a married couple or $12,000 for a single in 2018 and going forward. Before, it was only, what, about $4,600 or so? So it has gone up astronomically. So that's a good thing, but we're going to talk about some of the bad here in a little bit of why that jumped up, but how it's going to come back and bite you in a little bit. You can itemize your deductions. You always do Schedule A. Here's a big one for some people. The mortgage interest on debt up to $750,000 of debt acquired after the end of the year. If it's over 750, guess what? You don't get to deduct. So that's going to be one of the things that holds you back. Charitable gifts of cash or checks up to 60% of your adjusted gross income. So if you want to give 60% of your income away, hey, you can count that as a charitable gift. And then here's something, because Texas has high property taxes, the state and local property tax, you can only deduct up to $10,000 of your property tax. This affects me and a whole lot of people in my neighborhood, I know. You still get the additional deduction for 65 plus, and if you're 65 plus and blind, then you also get that deduction also. Now, Let's talk about exemptions. Hey, you get an exemption for being alive. Remember, it used to be $4,050 per person in your household? Well, guess what? That's gone. No more. Why? Because you get the $12,000 per person exemption or deduction. All right, what are tax credits? Tax credits, they incentivize taxpayer behavior. They want you to do something. So that's why we have the healthcare tax credit. They want you to have, part of the Obamacare, they want you to have health insurance, earned income tax credit, education credit, saver credit, child credit. So all these credits, these are a credit on your taxes. So it's $1, usually it's $1 for dollar reduction of your taxes. So if you have a saver's credit of, let's just say, $50, it's going to lower your taxes that you owe by $50. And we'll show you an example here in a little bit. All right, so here's an example. We're going to talk about different deductions, exemptions, and credits here. This is an example. You've got a couple. They're married, filing jointly, and they've got $38,000 of income. So minus their deductions of $24,000, that's the standard deduction now, then $1,300 times 2, because there's a couple, they get the deduction for being over 65. They've got $26,600 worth of deductions and exemptions. Hey, that's pretty good. That's going to lower my taxable income. They're obviously still working because they made a $2,000 IRA contribution. Going to lower their taxes some more because that's a $2,000 deduction. So the income subject to tax is $9,400. Puts them in the 10% bracket, right? So now they have to pay tax of $940. But wait, there's more. Just like they say on TV. They also have a saver's tax credit for the IRA contribution of $1,000. Basically, half of the IRA contribution goes to the saver's tax credit. So their total tax due, $0. Not bad. They get away without paying any tax. Well, we'll show you some of the gotchas here in a little bit. Now this is just for example purposes. Everybody's situation is going to be different, so be sure and talk to your CPA or your tax planner, and they will help you work through it. If you have questions, we're here to also answer questions. All right, so the middle income, married filing jointly brackets, like we said, around 26.6. If you're over 65, that adds in. So you don't have deductions. All right, the real tax system. Let's talk some more about it. We're going to talk about required minimum distributions, capital gains, Social Security, Medicare premiums. This is one that's near and dear to Julie's heart, is the Medicare premiums. Potential Roth conversions or large withdrawals, and the 3.8 net investment income tax. That's if you are up in the higher tax bracket. And these others, the personal exemption phase out and the P's, they're done. And then of course we must always touch on alternative minimum tax. That's the one that gets my goat, is the alternative minimum tax. Okay, how do RMDs, or required minimum distributions, work? In the year that you reach 70 and a half, you must take money out of your IRA. If it's a Roth IRA, you get a pass. You don't have to. But if it's a regular IRA, you must take out what is called the required minimum distribution. So here's an example. IRA's got $500,000 of a balance. The divisor for the first year is 27.4. So this person must take out $18,248. If you do not, there is a 50% penalty, and the IRS will find out, because wherever you have your money, they're going to tattle on you. They're going to tell the IRS, hey, you know, they got this amount of money and they didn't take any out. So they're going to tattle on you. IRS is going to send you a nice little letter saying you now owe us $9,124 in penalties, and you still have to take the money out and then pay tax on it. So what we've done here is, if you haven't already set it up, we've set it up where most times your required minimum distribution, we make sure it's done by Halloween. We're either calling you, or we've set it up automatically, or we're making sure that your required minimum distribution is done by Halloween. That way, if there's any kind of hang up or hiccup, we've still got 2 months to get it done, because I don't want anybody to have to pay that 50% penalty. Is that clear? Does that make sense? So here's the table 3, which is the lifetime expectancy, and you can see the number, the divisor gets bigger and bigger and bigger the older you get, so that essentially by the time you're 92, you're taking out 10% of your account. They want the account to be drained by the time you leave this world. So they're going to force you to take the money out. So let's just say you've done really, really well, you've saved, the account continues to grow even though you're taking your required minimum distributions, and now you're 92 years of age. Your divisor is 10.2, essentially 10% of your money must come out. So if you've got $1 million in your account, guess what? You're taking out almost $100,000 and paying taxes on it. And that would be one heck of a penalty to have at age 92, you know. So it just keeps getting, the divisor just keeps getting bigger and bigger. And here's some, yes ma'am.
This is on all pre-tax IRAs or all?
It's all qualified
IRA,
money.
qualified.
IRA, 401k,
401k.
457s,
So you
anything
combine
like
them,
that.
and your minimum distribution is the combined
Yeah.
amount divided
Correct.
by the buzz. Okay.
Correct. If it's a Roth,
It doesn't.
no harm, no foul. You don't ever have to take money out of the
You can
Roth.
take them all out of one account.
Yeah, you can get all
Yeah.
that account, but you have to take that.
Correct.
Yeah, okay, I got it.
You do, but you do have to take out. So if you have an account here that's got 100,000, an account here that's got 300,000, another account that's got 100,000 for the 500,000 that we just talked about, you can take the 18,000 out of one account. That's fine.
Yeah, but you have to take that.
But you have to take the whole amount out.
Then the exception to that is TSP has to be separate. TSP
if
has
you-
to be a separate, you figure your TSP and take the out of that. It's not, you can't combine it with the other monies.
It depends on if you've left your money in the TSP.
Yeah.
That
Yeah.
is
It's
a
still in the
TSP
TSP.
rule.
Yeah.
If
Yeah.
you've left it in the TSP, then that would when that would
Yeah.
make sense.
You can't. You have to take whatever
It's
specifically
separately.
for the TSP. And that TSP, for those of you that aren't governmental employees, that's the 401k for government employees. All right. Capital gains. Sometimes mutual funds pass through what they call phantom gains. That happened a lot in 2008. What are phantom gains? Phantom gains are, let's say a mutual fund company bought Apple back in 2000. They've owned it all this time, so they've got a lot of capital gains on this Apple stock that's in the mutual fund. You buy into the mutual fund in August. And they decide, well, Apple's not going to do very well. We're going to sell it, and they sell it in November. Well, guess what? By law, they must pass all those capital gains through to you all. So guess who gets to pay the capital gains, even though you've only owned the mutual fund for maybe 2 or 3 months? That's where the phantom gains comes in. So you're going to be stuck with that. Fortunately, our funds that we use through Matson Money, they're they try to be very, very tax efficient. You're still going to get a 1099 if you have a regular account, but they try to make it as tax efficient as they can. So, and that's why we don't do a lot of buying and selling, because we don't want to have phantom capital gains. We do rebalance, and here again, we try to be very tax efficient with our funds, so there shouldn't be too much in capital gains with us rebalancing. And then long-term gains can create ordinary income tax. So if you have a whole lot of long-term gains, it can affect your taxes that way. Okay, guess what? Social Security, part of it is taxable. How many of you knew that? Yeah, just about everybody in here knew that. So, what they figure is your Social Security is taxed based on your other income. That's called your provisional income. So in this scenario, 50% of your Social Security benefit is calculated, plus your ordinary income, plus dividends and capital gains, and then non-taxable interest. And that one really bothers me. There's a lot about the tax code that bothers me, but that one really bothers me. So if you have municipal bonds that are supposed to be tax-free, guess what? That gets counted in your provisional income on where they can tax your Social Security. Well, it's supposed to be tax-free. Well, it is, but it adds in to tax your Social Security. So they get you one way or another. I mean, it's one of those things that ends up bothering me a little bit. All right, so what are the thresholds? For a single person, if you make over $25,000 of your provisional income, 50% of your Social Security is going to be taxed. Over $34,000, 85% of your Social Security is going to be taxed. For married filing jointly, it's $32,000 and $44,000. And you're going, well, that's kind of confusing, Tim. How does that all work? We're going to show you. All right. So we have an income of $50,000 minus the 32. And where did I get the 32? Right here, for a married couple, is $18,000. 50% of it is going to be considered part of the tax, so that's $9,000. Well, you still have income that's above that, so you subtract the $44,000, that equals $6,000 times your 85%. Remember, I talked about this. 50% up to here, and then 85% up to here. So $50,000 in income, that's how this is coming out. For another $2,100, your total taxable benefit, 55% of your Social Security is now taxable, or $11,100. Now, refresh my memory. You worked for 40, 50 years or whatever, and you put money, which was basically a tax, your Social Security, into the Social Security fund. Now you're getting it back, but they're going to tax it again. Isn't the IRS system great? All right, so let's look at doing things a little bit differently. Let's say you've got $40,000 of Social Security with a $20,000 IRA withdrawal. That makes your provisional income only $40,000. So you got $40,000 minus your 32, that's $4,000. You don't have any over the second threshold. Remember, it was $44,000 for the second threshold, or the 85%. So now your total taxable benefit is $4,000, or 10% of your Social Security income. So waiting or delaying on Social Security may affect you. Taking it early may affect you. These are things that you need to think about, so that you know where your income is going to be going forward under the new tax laws. Does this make sense? So see here, with $20,000 of Social Security income, they probably took early. Here they waited until maybe 70 to take their Social Security. And each person's situation is different, but there are things that we can look at to kind of help you out. Same amount of income, it's just the provisional income that we were talking about has changed. And it's all about keeping what you get and what you make. So that's one way for us to take a look at it. All right, so here's how it would break down on the return. You got $40,000 of an IRA, $20,000 Social Security, or $20,000 from the IRA and 40,000 Social Security. Taxable Social Security, other income, total tax minus the deductions, net taxable income, you're going to pay $2,500. If you do it the other way, pay no tax. Same amount of income. So you can see how you can play the tax code to keep more money in your pocket. Medicare premiums, Medicare excess premiums, married filing jointly. If you have an income over $170,000, you're going to jump up into the annual premium of essentially another $156 added on to $134 that most people pay. Most people in this bracket, that $1,608, that is $134 a month. So they look back at your income from the year previous, and then they start jacking it up. And so it takes a while, especially if you just retire. They're going to look at what your income was, and so you may end up paying extra your first year or two until everything kind of settles out with your whether you have a pension or Social Security or whatever.
Also, if your spouse is still working,
Yes.
that can cause this to go up
Yes.
as well, because they take that into account.
So you're going to pay. And pay and pay and pay. All right. If your adjusted gross income for a single person's over 200, or if you're married it's over 250, you're going to pay an additional 3.8 tax on capital gains, interest, annuity payments, passive business income, and rents. So even though it's passive income, if your income as a married couple is over 250, you get to pay the extra 3.8% tax. Okay, the PEP and Ps has been eliminated. This is all gone, so I'm not even going to bother talking about it. Don't need to talk about it because it doesn't matter. Alternative minimum tax. It's a nice concept. You know, it's conceptually simple. It's a flat tax of 26 to 28% of income over what they claim to be a relatively high threshold. The difficulties in the calculation, that's where software comes in. You start with your 1040, then work backwards, adding back in deductions, adjustments for transactions that were treated differently. Basically, you need to have either a CPA or really, really good tax planning software to help you figure out if you are subject to AMT or alternative minimum tax. It gets real complicated on adding stuff in and taking stuff out and what you can and can't do. The effective marginal tax rate. We've kind of touched on that. How much of your last dollar do you actually lose to Uncle Sam? Remember, you get the first deduction, but then $1 over, and now you're thrown into a higher bracket. And we talked about the big jump from 0 to 10 or from 24 to 32. Those are big jumps, so if you can avoid that, then you can keep your taxes lower. Same with the long-term capital gains. We can try and control your taxes with capital gains, maybe some loss prevention and things like that. So let's talk about a case study. And I'm going to turn this over to Bree. She's going to go through the case study, and then she's also going to show you the software that we have that can kind of help you figure out maybe I can do something this way or maybe I can do something that way to help lower your taxes.
Thank you, Tim. Okay, as most of you know, I love the case study and the software stuff. This is really where I get super excited. I know it's an odd topic to get super excited about, but this is As I call it, my jam. This is what I love. So, feel free to ask any questions as we go through, but here's our first case study. And this is how the real tax system works. So we've got John and Jane. Names have been changed to protect the innocent. Filing jointly, they're 65. They make $60,000 combined, Social Security. They have $15,000 of net long-term capital gains that they've got for the year. They also have $45,000 in required minimum distributions. Does anyone know what that tells us?
That's a lot.
Same.
Yes, but it also tells us they're not just 65.
Yeah.
They're over 70 and a half.
Yeah.
See, to me, this is a puzzle. This is where I get really interested in it. I know, I'm a nerd. I'm a financial nerd. You might as well all know. Okay, so how does that affect? How does the real tax system affect them? So this is the tax map that Tim showed you earlier, is in the red. But then once you add in the Social Security, the long-term capital gains, and then this required minimum distribution, so this is the money they took out of their IRA, really their personal tax map is here in the gray. And here's what I don't like. I don't know who likes to pay 50 cents on the dollar to the IRS. So let's see how they got that one spike up of the 50%. Because, you know, even I've been paying into Social Security for quite a while now, and I want to make sure that I'm getting as much as I can out. I remember the first paycheck I took home. You can ask Tim and Julie this. Some of you have heard this story. I worked at a sporting goods store here in Fort Worth, and I was a tennis player, the high school tennis team, but I worked in the sporting goods store because I got a good discount on shoes and tennis rackets. And I knew how